We have filmed this investment update on the 7th of April 2026. We acknowledge that there is a lot of market volatility and that the remarks may have been outdated by the time of this release. Hello and welcome to Generate's investment update for the month of April. We are very lucky to be joined here with resident investment specialist Greg Smith, and I am Matthew Hanchet, Generate's investment distribution manager. Thank you for joining me, Greg.
My pleasure.
Now, I thought we'd kick things off with the inevitable. The war on Iran is in its second month. What have you made of the market reaction, and what would the key lessons from history point to for investors?
Yeah, I mean, obviously it's been pretty disturbing. Sort of anyone sort of watching TV or online, looking at obviously all the images of what's been going on in the Middle East, and sort of in a way came from a bit of a bolt from the blue when you think about it at the end of February. It seems to be very much soundbite driven, depending on what the noise is coming out of the White House, whether it sort of be hardline or whether it be backing back, and obviously the response from Iran. And meanwhile, we've seen periods of sort of ceasefire, if you want to call them that, but obviously we've seen a lot of missiles flying everywhere. In terms of the market reaction, getting to that, I would actually say it's been probably not as bad as some would have figured. So if you look at the major indices, so the S&P 500 for instance, look at some of the indices in Asia, and indeed ours sort of close to home, we're sort of down around about sort of 5 to 10% from record highs that were seen in January or February, or in some cases March. So thinking of it that way, it's perhaps a little bit more measured than could otherwise have been the case. Still, obviously, we have seen decline in the indices, and the key thing is where it goes from here. I mean, no one knows how long the conflict is going to last. But I think a key lesson for investors, and particularly those that are perhaps looking at their KiwiSaver and looking at the volatility they've seen over the past 6 weeks or so, is to appreciate that markets do climb a wall of worry. And obviously it feels like a lot of stuff's happened in the last few years. Obviously we've had the pandemic, we've had Ukraine, now we've got the Iran war. But you look through history, crises are regular events. They can and do happen, should I say. And I suppose the key commonality is that markets do climb a wall of worry. They look beyond the crises eventually and they move higher. So if you're coming into this with a long-term perspective, I think it's really important to appreciate. Take a look at a chart of the S&P 500 going back to the start of the 19th century, or you look at other crises. Obviously, we had the GFC, we had the dot-com bubble, we had 1987. People still talk about that crash in New Zealand. So if you look at each of those instances, they've been relative blips in an upward trend. So I think it's really worth remembering and taking some comfort in. And also the fact that we at Generate are active investors. So we're not sitting back just watching this volatility unfold. We're using it to take advantage, to make the most of opportunities, not react to the noise as some are, and actually look to benefit from what's happening. Obviously, everyone wants to see the conflict resolved, but we certainly aren't sitting on our hands by any means. And there's all sorts of things you can look at how things might recover. Obviously, COVID, we saw a really sharp drawdown, really sharp. Actually, the volatility that we've seen during the Iran conflict is nothing in comparison to perhaps that, and also the if you look at standard deviations, what we saw when Trump held up his sort of tariff board. But they obviously recovered in both instances. The pandemic, obviously we had the vaccine, Trump's tariff board, we sort of got beyond that. So markets can and do recover, and I think that's really worth remembering.
Yeah, I think it's always, very seldom is there a case in the world where nothing's happening. So it's always happening. There's always things going on, and there's many a crisis to look back at and see how the market's reacted. Because high oil prices have clearly been a really hot topic of discussion, and especially with that Strait of Hormuz still apparently being closed. How do you think the oil prices have affected the state of growth and inflation in global markets?
Yeah, hugely relevant, isn't it? As an equity investor, we've seen stock markets move inversely to the price of oil. So when oil's had an up session, stock markets have typically been down. The reverse has been true if there's been some sound bites around a ceasefire or around a de-escalation. You've seen the oil price fall, and then you've seen equity markets rise. So very much an inverse relation. And of course, real world consequences as well. We're now paying $3.50 for oil in New Zealand, for petrol, should I say, in New Zealand, and that's quite disturbing for consumers, whether you invest in the market or not. Real world consequences, cost of living, and the like. So yeah, the longer it goes on, the more you will have that transmission effect, to the real world. If we saw oil prices elevated at over $100 for a sustained period of time, say 6 months or more, then yeah, that would have an increasing impact. I think a key point about what we're seeing at the moment, and you get a lot of comparisons with the, you went around then, but the 1970s oil crisis.
Yes, of course.
And oil prices quadrupled, right? And there's probably one key difference is that the economy, or the global economy going into that, was somewhat weaker, whereas I think we're coming from a bit more of a position of strength. New Zealand's economic recovery has been a bit more fragile, but you look at the US, job creation's been strong, inflation is a lot lower than it was back in the 1970s. I suppose another key difference as well, and Donald Trump made reference to that in a recent speech, that the US is a net exporter of oil rather than a net importer, so far less reliant than it was in the 70s. And that's not dismissing what we've seen in the oil price, but I think it's not as problematic as it was back then, when in New Zealand we actually had carless days and the like. But the Strait of Hormuz, 20% of the world's oil goes through there, particularly to Asia, which obviously is very relevant to us. So we do need to see that strait get moving again, and not saying we can sort of do with it being log jammed for the rest of the year. But we are sort of looking at ways that it can come out elsewhere. You've got this east-west pipeline in Saudi Arabia, so they're looking to get some of it out through the Red Sea. But yeah, we do need to sort of get it moving again. But I think we can take a little bit of comfort from, in the near term, things aren't as bad as perhaps the 70s. We've got strategic oil reserves as well, so not New Zealand hasn't, but a lot of nations sort of do have those as well. So I think we can certainly withstand it near term. Filming this today, we haven't seen huge damage to energy infrastructure. We've seen some, but it's not going to necessarily take years for oil infrastructure to recover. So I think we can take some comfort from that as well. And then the other thing I think was interesting, if you look at, is the actual futures market for oil. So even though the oil price has been around, say, $100 to $120 thereabouts, it's risen almost 80% since the conflict started. You look at the futures market for oil for delivery 1, 2, 3 years out, it's actually heading back towards $70. So perhaps like the equity market, oil markets, commodity markets, think this is not going to be a prolonged conflict. Of course, we don't know the answer to that, but I think that does provide some comfort.
Oh, interesting. It's certainly a good period for Tesla and other EV owners, for sure. Now, I want to talk about us as active managers. So we are active managers. What does that mean really? Is that instead of owning an index, we get to choose what investments we buy, what companies we buy stocks in, what companies we sell in. How are we managing this period of uncertainty?
We have stuck to anything. We've been very active, and we've made lots of changes to the portfolio. We focus not on noise, not on emotion, but on quality and on the value that we're getting when we're buying into stocks or holding companies. And we've certainly been doing that in spades over the last sort of few weeks. So I made lots of positional changes across our portfolio, adding to companies that we believe have oversold and represent even better value than we perhaps thought before the conflict. Our investment team look at the intrinsic value of every company that they own or potentially going to own. So what do they think it's worth, both in terms of quantitative and qualitative metrics? And some of those companies which they held have become even more sort of undervalued in their eyes, and that's effectively what we're looking at. So we've added to some of those positions. We have also reallocated in some cases where we see better opportunities elsewhere. So we maybe have exited positions, and there's a number of companies that have actually taken profits in going into this crisis as well, and reallocated elsewhere. But yeah, an example, I suppose, that we're increasing our exposure to is agentic AI. And it's a thematic that we liked, heading into this crisis. But you've seen, a number of names sell off, not hugely, but those names that perhaps have sold off a little bit, we've been adding exposure to. And the things, I suppose, the reason we're so positive about AI is, and ultimately we're looking at what the earnings growth that's being delivered. And it's interesting, if you look at the earnings season in the US, which is getting underway as we speak, and we'll still have some time to run by the time this airs, is that the earnings per share growth rate expected for the technology sector is 45%. Now, you
Wow.
often get when we often go around we go on the road shows or go and talk to people, and people go, tech companies are expensive, but these companies are growing at rates which are far more than usual. And if you look throughout history, typical earnings growth for the S&P 500 has been around about 8%. You've got Nvidia growing at around 60%. You've got other chip makers growing at huge multiples as well. So that's what we like, and we do see it as being sustainable as well. Just interestingly, the tech sector is expected to grow at 45%. S&P 500 is 12% average. The next best sector in terms of earnings per share growth for this quarter is financials at 14%. So it's night and day in terms of the growth you're getting for what you're paying. You look at Nvidia, it's trading on around about 25 times earnings. That's against the S&P 500, which is around about 19 times thereabouts. So you certainly see value in that sector. We've been adding those types of positions. And also because I suppose ultimately the AI thematic, we're using it a lot more than we were a few years ago. I think everyone would agree there, but still at quite an early stage. So it's around about 19% of firms in a recent survey said they were using AI regularly in their business. So, we've got another 80% of corporate America that's not even using AI. So I think that tells you the growth is to come. We've also been, outside of technology, also adding in other areas as well. So we've been highly active during this period. And I think that's also one advantage of periods of volatility versus periods when the market is just going up in a straight line. And that sort of suits all types of investors. Passive investors, for instance, happy to go along for the ride. When you get this sort of volatility, I think that's when a good active investors really earn their stripes. Passive investors have to simply, I suppose, go along with the flow.
Yeah, it certainly sounds like there's some pretty good opportunities out there. So we spoke about how times like this is where active investors really tend to prove their worth. Do you think the reverse is true for many DIY investors at home?
I think sadly it is. And again, you're not just sort of saying that. There's sort of studies to back this up. And when things are going well, DIY investors can sort of pat themselves on the back and think, what do I need? An active manager, or why do I need a fund manager to help me? And I think it is times such as these that I think there's a phrase coined, might even be Warren Buffett who coined a phrase that when the tide goes out, you can see who's swimming naked, and that's perhaps sort of relevant here. So the S&P 500, you look at the last 20 years, the average returns around about 9 to 10%. For an average DIY investor or retail investor, it's around about 5 to 6%. So 3 to 4%. That adds up to a lot. It's an enormous amount over time. But I think also what you get during periods of volatility is you basically get panic, or you get human sort of behavior kicking in rather than discipline. And that's not saying all, because there's some great DIY investors out there, but generally you see that behavior kick in. And that often means selling during periods of stress, or making the wrong decisions during periods of stress, and not just sort of selling companies that may be going down in value, but maybe selling some winners because that's the only thing that's sort of in positive territory. And then I suppose what sort of that lends itself to is then you're effectively trying to time the market by doing that. So, and I heard someone the other day say that, so I'll get back in when things settle down. I think, well, how do you know when things are going to settle down? Donald Trump doesn't know when things are going to settle down. So it's pretty, and the other thing that goes along with that, and you can do that, but the market does react ahead of time typically. And there's another interesting sort of study which shows about the cost of missing the best days in the market. So if you miss the best 10 days during a period of volatility like this, your potential returns are going to halve. That's basically what studies have shown. If you miss the best 20 days, you're going to be looking at low single-digit returns at best. If you miss the best 30 days, your returns will be close to zero. So it really shows you trying to time the market rather than time in the market is just not the way to go statistically. Some people can do it, and I think that's where some DIY investors sort of fall down. And actually, I've actually heard institutional managers not talk about this as well. Sort of other places talking about trying to sit out and go into cash when history shows that's not the right approach. Active investors, whether they be institutional or otherwise, use these periods to their advantage to increase positions in high quality companies, and basically sort of let their strategies be proven over time once that volatility subsides. And again, there's all sorts of studies which show you what happens in the wake of geopolitical conflicts like we're seeing. There's one that showed over time, going back to the 1950s, the S&P 500 is almost 6% higher within 5 months of a conflict starting. And that's on average. Not saying that'll happen this time around. So that's what we suggest doing, and that's certainly what we are doing as active investors, is not trying to time the market, but using it to our advantage.
Yeah, well, it certainly shows the value of having experts like the Generate investment team looking after your investments, doesn't it?
Absolutely.
Yeah. Well, thank you very much, Greg. That's all for today, and thank you all for tuning in to this month's investment updates. Please don't forget to like, follow, subscribe on anywhere that you see this content.